All right, so we have a video here, the quickest way to save money. So let's see what she has to say.
The quickest way to boost your savings account is to work so much that you don't have time to spend money. Life hack. The quickest.
Okay, yeah, just I think that's advice that Jeff Bezos would give you for if you worked inside an Amazon factory or Amazon delivery. But okay, like save money, just tire yourself out, and you don't have enough time to even go to the bathroom, so you got to pee in a bottle, right? So we're gonna do the opposite, which is to not save money, and especially when it comes to debt payoff. And that's what we're going to do using something called a velocity method. So if you don't know what that is, we've been doing at least 700 videos of this in this channel, and we're just going to keep doing it because this is going to be the number one debt payoff channel. I don't know why, but I feel a little bit inspired today, even though I haven't really changed anything about this. But let's go ahead and make this the number one debt payoff channel on YouTube. All right, so let's go ahead and get started. How do we start? Well, first of all, we have to create a budget because a budget is a debt attack plan. So we have our income, expenses, leftover checking and savings. And how many debts do we have? We have one, two, three, four credit cards, an auto loan, a student loan, and a mortgage. And then on top of that, we live a modest life, 1,500 a month, which is really not that much if you account for inflation. So all in, all of our expenses, including the mortgage, is a little bit over 2,600. Okay. And so what we're going to do here is we're going to copy our income, our expenses, and show that with the same income and expenses, we can increase to something called cash flow. So how do we do that? Well, basically, we kind of have to do the opposite of what she's talking about, which is saving money. And we're going to assume we have the same lifestyle, right? So instead of saving money, this checking and savings is going to go to zero, and then we're going to focus on increasing this thing called cash flow. Now, so philosophically and conceptually, there's a difference between here and here, even though these two numbers are the same, right? So here, basically, your checking and savings account is seen as the final destination of your money, right? Whereas here, your line of credit is seen as the final destination of your money. And you might be asking, what is a line of credit? Well, it's basically a financial tool where you could borrow money, pay it back, and then use it over and over again. The line of credit, okay? And so if you have a credit card, that's technically a line of credit, but we don't use that as our main operating account because credit cards are a little inflexible. They're very flexible in 90% of cases, but we need that 10% that a credit card doesn't have in our flexibility when it comes to making overpayments, right? And so if you overpay a personal line of credit or home equity line of credit, it's so easy to get that money back. But with the credit card, you can't use one credit card to pay another credit card, right? You probably could use a credit card to pay a loan, but even then it gets restricted. Like if you ever use plastique.com, you can't use it to pay what is it, an Amex to pay a loan or a student loan. So just all these restrictions. So we're going to use something called either a personal or home equity line of credit. And because we're a homeowner, assuming we have equity, if you don't know what equity is, it's just basically the amount that your home is worth minus any debts tied to it, right? So $300,000 home minus $200,000 debt, okay, means you have $100,000 of equity. And then the bank sees that and say, hey, you know what? Maybe if you have like 80, or we'll actually, if you have $100,000 of equity, we'll loan up to maybe 80 to 90% of that equity, right? And so the idea is that you're basically getting a huge credit card like device, not an actual device, instrument, 80 to 90% of it based on the value of what's left over after you pay off your debts that's tied to your home. And then if you don't pay up or pay the monthly bill, which is usually the interest that's accrued, they'll usually try to foreclose on your house, right? So usually you get lower interest rates, you get higher limits because your home is worth so much if they decide to sell it. Now, if you know how the bank's business model works, there's two things you need to know. Number one, a bank doesn't want to foreclose on your home, right? You see, if a bank forecloses on your home, that actually makes the bank look bad. So that's why they'll do anything to not foreclose, but obviously they want the monthly payment. And the reason why, okay, they don't like foreclosing is because they're not a real estate company. They're a collect monthly payments company, right? And so that's why they make sure before they ever loan you the money, they want to verify you don't need the money. Because banks don't lend money to people who need it. That's point number two, right? Banks don't lend money to people who need it because, in the eyes of the bank, people who need money are very, very bad people, right? They're very bad people because they don't pay you back. And not only that, the bank wants to make sure that whoever they lend to um, isn't getting their life force, aka their cash flow, drained by other debts, right? So you think of the bank as a vampire. If the vampire sees that other vampires are draining the blood out of your prospect, the bank will say no thanks. There's no blood for me to drain, right? So that's why we only have $78.95 left over. So that's how you think of the bank. Now, why do we demonstrate with the free and clear line of credit? Because it's kind of like, hey, it's a chicken and the egg situation, right? Bank won't lend you money to if you don't need it, but so you have to get these credit lines before you ever need it. But a lot of people try to get it when they need it, and then that's where they fail. But if you see the demonstration where the bank would give you a credit line when you needed money, you'll be like, "Oh my goodness, this would have been a lifesaver even though I'm not making more money," right? And also we have realistic scenarios behind a paywall, 99 cents live stream, right? Members only YouTube. You want to see that, join the YouTube channel, 99 cents a month, and then you get to see the realistic scenarios of 22 debts, $4 left over, and $5,000 a month in income. And I can't even believe I'm saying realistic. I was like, what? Is that real? It was real. And we did a live stream on it. 99 cents. 99 cents, folks. All right. So now the final step is that, or actually not the final step. The next step is that we're going to calculate something called the cash flow index. So basically, what is it? It's basically the balance of the debt divided by the monthly payment, right? So 5,000 divided by 175. And then this one is 8,000 divided by 260, and then this one is 15,000 divided by 487.5, and then so on and so forth. 000 divided by 855. Okay. And so now what I'm going to do is actually kind of get these cash flow indexes from my calculator that I have. So let me just copy and paste this. So what do these cash flow indexes mean? They're basically a ranking system, right? So what you do is you rank these debts from smallest to largest based on the cash flow index, and you pay them off according to this order, right? And anything below 50, that's good to pay off. Anything 50 and 100, it's like and then anything above 100, that's like, oh, be careful, don't pay that off right now. So here's the thing about the mortgage, right? Why is this so high? It's basically saying, hey, I literally have to give someone $250,000 in order to get $1,100 back in my cash flow, right? I know a lot of people want to pay off their home because it's like, oh my goodness, this is tied to my survival, right? But let's pay that off, but pay it off last, okay? However, when it comes to the mortgage, I'm not, I'm not the mortgage. When it comes to credit cards, we should pay this off first, right? Because if I combine these credit cards, that's more than I think $1,300 of cash flow. And so, what makes more sense? Pay $42,000 in credit card debt and get more cash flow than this 250,000? I think that makes a lot of sense, right? So that's why you follow the cash flow index. In fact, I actually did not use the cash flow index extensively until I had two separate people randomly emailed me their budgets and their spreadsheets. They looked at the channel, and one person had 10 debts. That was the first person who emailed me, and I was like, this is overwhelming. And then I just used the cash flow index. Like, that's not overwhelming anymore because I know I have a way to figure out which debts to pay off, right? And then the second person sent me 22 debts, and I was like, whoa. Okay. And so now let's go ahead and do this. So we know which debts to pay off. And so what we're going to do is move 5, 8, 15, 27. I'm going to go ahead and sum this all up. So this is going to be $55,000 of credit card debt and move it into a home equity line of credit. Now, it doesn't have to be 100,000. We could just make this 60,000. I'm just making up arbitrary numbers, and as long as this is above the credit card balance, then it makes the demonstration easier. But take a look at this. This is the part where a lot of people can't believe it, where I say, hey, if all you do is transfer debt, don't these credit card payments go to zero? Kind of like a credit card balance transfer? And then doesn't this $78 turn to $1,856.45 without making more money? So you see how the income is the same? Like the income is literally the same, right? We didn't increase our income, okay? And we didn't save more money. In fact, we saved zero. We saved zero. But we're throwing all of our income into the line of credit, taking our expenses out and rinse and repeat over and over again, which is the final step. 5,700 line of credit, take out the 3,800 to pay all of your other bills right here, right? So we have the auto loan, student loan, mortgage, and our personal expenses. And even with these personal expenses, I would just run them on a credit card. And I'll make another video about that because a lot of people were fascinated by this. Doesn't mean we still don't use our credit cards. And if, in fact, at this point, when our credit cards are paid off, they're like 1 month free loans if we always pay them off, right? So that's kind of how I think about it. All right, so now let's take the final step, which is to set up the monthly calculations. And then what we're going to do is to get the next month's balance based on the previous month's balance interest minus our cash flow. Okay, and then we're going to take the interest, take the average daily balance, multiply by the interest rate, 0.08, and then divide by 12, right? So that's how you get the interest. So think about this. The monthly cost of that line of credit, the very minimum payment, which will be the interest, which is $360.48. And if they tackle on a little bit of principal, who cares? Because you're putting the entire $5,700 into that line of credit, taking expenses out and rinse and repeat over and over again. So if the monthly payment is only about $360, then you can definitely put the $5,700 paycheck, right? So let's go ahead and do this. And then now I'm going to go ahead and copy and paste. All right, and so now this is what we're going to do. Okay, and so it's 33 months. We paid it off, and we're just going to mark that as our milestone, 33 months. And look at what we achieved by not saving and not working for Jeff Bezos, and we depleted our savings. We didn't save money. I don't get this advice, but it is what it is. It's TikTok, right? That's why you know older people call it the ticky talks, just to be seem like we're out of touch, right? Okay. Auto loan, student loan, and the mortgage. And so at 33 months, let's go ahead and do this. What's the current balance of all these other debts? We have this loan calculator right here. So it is 10,308.69, right? 10,308.69. And then you see these cash flow indexes right here. And then what we do is we just take these formulas, or I'm sorry, these debts, and then pay them off according to cash flow index. So I'm going to do this right here, and then we're going to move it to here, okay? And then this is going to be plus 10,308.69. And then guess what happens to the auto payment? Well, this goes to zero, right? And then their cash flow is $2,251.76. And I'm going to copy and paste this right here. And then it's going to be 22251.76. And then I'm going to copy and paste this. And then we see that in month 38, the auto loan was paid off, right? So the auto loan is paid off. So I'm going to just do this. So 38 months. And then this is going to be 55 plus 22. And this is going to be 77K paid off. And then now all we have is the student loan and the mortgage, right? So let me just do this. This is going to be month, was it 38? Yeah, let's do 38. So this is going to be 0, 38, 38. And we have a 7% interest loan and a 4% interest, or student loan, I'm sorry, 7% interest student loan, 4% interest mortgage. Now, should we always move the loan into a line of credit? The answer to that is it depends. I have a couple of rules regarding this. So number one is if this cash flow index is relatively low, even if you have a low interest rate, lower than the line of credit, it's okay to move it. That's one rule that I have. Another one is if the interest rate is the same or higher than the line of credit for the loan, which is typically not going to happen, but if that happens to be the case, then yeah, I will move that loan into a line of credit, or I could do it, right? Not, it doesn't mean you should always do it, but that's something worth considering. Another one is if you have a low interest rate loan and you have a really long term, meaning your cash flow index is relatively high, probably not move that loan into a line of credit. In fact, I'll just say as a rule of thumb, don't do it, right? Because think about this. Let's say I move this 4% loan, $235,000, into an 8%, $235,000 line of credit, which is called the first lien HELOC replacement. You get this itty bitty amount of cash flow. Now the rest of your loan is at 8%, and the amount of cash flow you get isn't enough to offset that interest rate difference, right? So this is why, like in this case, with the 3% loan, we can move into 8% line of credit because we get a substantial amount of cash flow at that time. So the amount of interest that we pay is not going to just be tied to that 3% rate because it's also about volume and length of time, right? So got to be careful. Now I'm going to be a little bit lazy here and just move the 7% loan and 8% line of credit. Would I do that in real life? I don't know, probably not. But because I'm a little bit lazy, I'm just going to move this here. And then this is going to be plus 49075.99, right? We're going to round it. And then guess what happens here? Oh my goodness. This is going to be $754.71. And then now this is $3,006 of cash flow. And let's go ahead and update this cash flow here. And this is going to be 3006.46. Okay. And let's update that. And so how long does it take to pay off the student? Oopsie. Okay, so now in 61 months, this is all paid off. Do this, do this. Okay. And then I'm going to just do this. So 61 months. So it'd be 77 plus 65, 142K. And then now is the 30-year mortgage. So as I said before, we really have to be careful with this 30-year mortgage, right? So we are at month six, 61, right? So put 61 right here. This is the current balance of a loan. So you have two options, right? So I'm going to just tell you what the default options, which is just extra payments. So what does extra payments mean? It means you make the monthly payment and whatever you have, you just make as an overpayment directly into the loan. Now, just kind of think about this as an example. Why do people, if they know they can do this, why do they not do it? That's because overpaying any loan, which is a one-way street, creates friction with your budgeting and cash flow, right? So that's why we usually overpay lines of credit, because when we overpay a line of credit, that issue isn't necessarily there. Another reason why we don't necessarily do that is because when it comes to overpaying loans versus overpaying a line of credit, when it comes to overpaying a loan, you kind of have to know exactly how much you need to overpay, or else it does create friction. Whereas overpaying a line of credit, you don't have to be exact. This is why, like, when it comes to monthly budgeting expenses, I just kind of do averages, right? Like maybe one month you have unexpected expenses, but as long as you're overpaying that line of credit, who cares, right? Whereas with the loan, that really does introduce friction. So that's why I kind of talk about here, like what's the difference between extra payments and HELOC, or what we call HELOC sweeping or chunking, and which I'll explain a little bit later. Extra payments just leads to decision fatigue, and that's why nobody ever does it, right? That's real. Like I would say, hey, if you can do extra payments, you do it because that's probably the way to go. But most people can't do it. It's kind of like, if you introduce a little bit of friction into your daily tasks and chores, what's the likelihood that you're going to do it? You're not going to, right? It's kind of why a lot of people they can't do budgeting in Excel, because Excel is actually not a good platform to track your budget. I don't know if you knew that or not. It's not, right? I've actually introduced other tools on how to do that. So what you want is an easy system to help you overpay your mortgage. And what we do is we just do take our extra, actually take a piece of the loan, move it into line of credit, and then just send all our money into the line of credit. right? And it's much easier because your only objective is to get your checking account to zero and get your line of credit to zero. And then once you just do that, then it just becomes easy, right? Whereas extra payments, a lot of people know this is the default and they can't do it. Okay. And so let me just kind of show you how that would work. So basically, let's say I move $6,000 of the mortgage into the line of credit, right? So this is just kind of cowboy math. It's not exactly how it works because you're still making the monthly payment. But if I do this and then we just transfer, I'm again debt transfer into the line of credit. Well, let me just kind of go here. Actually, oh, did our cash flow get updated to $3,000? Well, this is good news because I probably screwed up. So let me just kind of go back here. So if this is the student loan, and let me see if it makes it. Oh, I only updated the cash flow in the first month. My bad. So let me see. So it'll be 56 months. What a miracle. Okay. So that's always good news when I screw up. So this will be 56. And let me just go here and then type in 56 months. That's when we paid off. So we're 6 months ahead of schedule. But anyways, my point is this, right? So let me just go here. And then if I do what we call a chunk or a sweep where we move $6,000 of the loan into the line of credit, you see that it gets paid off in about 2 months, right? You see how easy that is? So it just gets paid off in 2 months. And so a lot of times people say, attacking the principal is really hard if you overpay. And then what we do is just do it in sweeps, chunks, and then it just gets paid off over and over again. And a lot of people freak out. 8% line of credit, OMG. And for using that line of credit, yeah, you are going to pay a little bit of money, but it's you think of it as a bridge, right? As a bridge to help you overpay your loan. Okay, and there's a lot of software that kind of acts like that nowadays. So, for example, let's say you have like Salesforce and then you have Quicken Books, right? There is software literally out there to connect those two websites together, and companies pay a ton of money. Okay, they pay a ton of money for those what you would call middleware. So think of your line of credit as a middleware for your money, where instead of directly overpaying the loan, you're putting the money into the middleware. Okay, and I'm really serious about this. They pay a ton of money just to talk from one system to another, like Salesforce to QuickBooks, right? But you're only paying like $10 a month in this instance to help pay off your loan. Okay, so let me just go here, and actually I have a calculator that will tell us how fast we pay it off. So give me one moment to pull it out. All right, so basically what we're doing here is we're chunking slash sweeping $6,000 from the loan into the line of credit, and then we see how fast it pays off, which is 5.1 years, right? And a lot of times people freak out about the interest rates. So even if I use a 15% line of credit for this, look at this. This is the same time to pay off, but it's just a little bit more expensive, right? It's like 2 grand more expensive. And so even if we use a 30% credit card for this, right, you see how it's 4 grand more expensive, 24 to 28. And so even a 30% credit card, yes, it's not ideal to use it, but you could probably make it up in rewards points and all that good stuff. But the other thing too is that, just the interest rate is not the only thing that matters. It's about time and volume as well. So if I move this whole loan into a line of credit, look at that, 57 grand. So you literally almost double the interest you would have had to pay. And that's why it's like 57 grand for an 8% line of credit. Don't always look at the interest rate. Everybody just always looks at the interest rate, right? You need to think about volume. Okay, volume is like the most important thing or metric and total amount that you pay, not just one factor, which is the interest rate. Okay. All right, well, that's it for today, folks. Quickest way to not save money is just put it all into a line of credit. And that's how we pay off debt using a line of credit. Okay, well, have a great day, and I'll see you all in the next video.